and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, August 4th, and I'm recording this from my home office in Ridgefield, Connecticut. As we noted in our recent special report on American exceptionalism, 15 years of extraordinary policy accommodations have turbocharged the American economy relative to the rest of the world. They've also left profound economic imbalances in their wake between larger and smaller companies, wealthy and median households, and older and younger demographics. Now, as the impacts of the tax reform bill and global tariff implementation begin to roll through the economy, we sense that yet another series of great divides are opening up. This time between multinational exporters and importers, and between consumer-facing companies and business-to-business enterprises. Consider first the consumer side of the economy. As Piper Sandler has recently pointed out, investors should focus on the fundamentals of consumption, and here we see signs of slowing. In the second quarter, real final sales to private domestic purchasers rose only 1.2% annualized, cooling from the first quarter's rate of 1.9%. Real consumer spending has been rising just 1.4%, and residential investment actually fell, down 4.6%. Inflation accelerated in the second quarter, with core PCE coming in at 2.5% above expectations. Add to this the impact of the 10% weakening of the U.S. dollar, which reduces purchasing power and amplifies inflation, and these trends are set to get worse in the months ahead. Critically, this comes at a time when consumers are already showing signs of weaker spending appetites, while credit stress is emerging and labor markets are showing cracks. Quit rates and hiring rates are both down, and wage growth continues to slow. The share of consumers falling behind on credit cards and auto loans is growing fastest among people actually making over $150,000 a year. With imports at 12% of GDP, the tariff headwind could be as much as $500 billion of wealth per year that transfers from U.S. consumers and importers to the U.S. Treasury, more than offsetting their tax savings in 2026. Next, let's think about the story emerging from second quarter earnings. Companies that have missed expectations are disproportionately concentrated in consumer-facing and goods-importing industries like autos, airlines, hospitality, housing, and healthcare. Contrast this with export-oriented multinational companies that are not touching the consumer space. They're facing fewer external barriers to their exports, and a weaker dollar is helping with their price competitiveness. They're also typically more capital and R&D intensive and can invest with the certainty of the improved tax treatment and promises of tax savings in 2026. The Macro Institute has actually noted a considerable gap in performance since April 9th between the S&P 500 companies with high foreign sales and those with a domestic focus, suggesting yet another dimension of the haves-have-not equation. So with this new structural division emerging, global stock selection is more important now than ever. Investors should consider adding multinational non-consumer exporters where tailwinds are apt to continue. Also look for stocks with the potential for upside surprise in earnings and cash flow. We believe that they may be found in select tech names and other areas like financials, industrials, energy, and parts of healthcare that are policy beneficiaries. Avoid overhyped themes and complement your portfolio with diversifying positions in international equities, commodities, and energy infrastructure. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.